Hello, everybody. Welcome to Adjusting Journal Entries. This is part 6, depreciation expense, or the theory behind it. Now, for this one, I'm breaking this up into 2 different presentations, and it's because we need to understand the theory before we go through and do the question. When we purchase equipment, unless it's a BMW 7 Series, I'm just kidding. They only last for less than that. But in any, come on. You got to be really okay. So when equipment is purchased, the equipment will give us use over multiple periods of time, generally longer than 1 year. With equipment, we use this in our operations. That's very, very important. But to reflect when we're using it, we need to depreciate it. And the way that we depreciate it, there's a lot of different methods. There's double declining balance, there's units of production, there's makers, acres, all that other, some of the years digits if you're an academic. But what we're going to be focusing on is straight line. That means we're going to be taking the same amount every year, unless it's a partial period. But let's take a look at this. So when I record straight line depreciation, the way I'm going to go through and do it is I'm going to take my acquisition cost, right? It's the AC part of DC. No, acquisition. What did it cost me to acquire this equipment? I subtract the salvage value, or what I expect to sell that asset for in the future. Right over, I'm going to divide this by my estimated useful life, and this is going to be in years of time. This is going to give me my annual depreciation expense. So this is how much expense I'm going to be going through and charging every year. Now, because this equipment is going to be giving us multiple periods of time, this is always going to be shown as a non-current asset. So when we use, what we're going to do is when we record the depreciation expense, we know that, hey, DC, ER, we always record expenses with debits. So we're going to debit depreciation expense. However, we're not going to credit the equipment. Instead, we're going to create a contra-asset account or accumulated depreciation on equipment. Why is that? Well, the contra-asset account is going to carry, basically, it's going to accumulate that depreciation, and it's basically going to reduce the carrying value of that equipment over time. And this is how we go through and record depreciation expense. Remember, depreciation expense is going to be closed out at the end of the period to retained earnings, but accumulated depreciation on equipment is going to hang around, right? And it's going to basically reduce the carrying value of our equipment. So how is this going to look on our balance sheet, right? So on our assets section under non-current assets, remember, equipment gives us multiple periods of use. So I'm going to take the equipment less the accumulated depreciation, or how much depreciation have I taken to date. This is going to give me equipment net, right? It means net of the accumulated depreciation. Again, accumulated depreciation on equipment is a contra-asset account. It will have a credit balance, right? Assets, DC, ER, AELOE. Assets typically have a debit balance. But as you can see from over here, the accumulated depreciation on equipment is being recorded with a credit. So what we want to be really careful about is that that is going to be the way it's going to be shown on the balance sheet. It's going to reduce the carrying value of our equipment to give us equipment net of the accumulated depreciation. So this is a little bit of the theory behind us for depreciation and expense. I want to thank you for joining me here today. Please leave any kind of questions you might have below, and really appreciate you liking and subscribing to these videos. Have a great day.